I'm Polina Pompliano, Deputy Director of Live Events at Fortune, and we're here to discuss fundraising in an economic downturn with a great group of speakers. Some housekeeping. The session will be on the record, so anything said in this room could be used in a potential Fortune article. Additionally, I would love for this to be more collaborative and interactive, so we want to hear from you guys. So whenever you have a question, just go ahead and press the little speaker person on your mic, and it'll turn red, and you can speak. So after you're done speaking, make sure you press it again to turn it off, because we can't have more than 2 mics on at the same time. All right. Now let's start with introductions from the panel. We have Aidan Madigan-Curtis, partner at Eclipse Ventures. Jesse Draper, general partner at Halogen Ventures. Kirin, Sinha, founder and CEO of Illumix. Is that how I say it? Illumix. Monique, Woodard, founding partner and managing director at Cake Ventures. Welcome. All right. So as I was thinking about this panel, I had 1,000,001 questions, but the first one that comes to mind is I would love to hear from each of you. A lot of the startups that are founded today were probably founded during a bull market, but there's a whole other set of founders facing a different reality, which is tightening budgets, inflation, volatility, all sorts of stuff. So can each of you briefly share your outlook on this new market? Aidan, let's start with you.
Sure thing. Everything, can you hear me okay?
Just lean in more, I think.
Okay, great. Lean in, that's the thing. Got it. Wonderful to meet everybody. I think in terms of outlook, I think it's a little bit grim, but at the same time, there's a lot of evidence that great companies are started in every economic environment. I think the financial crisis last time around birthed companies like Uber and Airbnb and a lot of other sort of real outliers. So I think that there are probably many great companies that are being started today. I do think that it is pretty tough. I was just talking with Kirin about a great round that she just closed. You're not hearing a lot about that these days. I mean, if you look at the stats, it's pretty depressing. When you think back to about a year ago, we were seeing something like in the order of 500 or 600 early stage deals happening per quarter. That's down to sort of low, anywhere between 150, 200 in the last couple of quarters. We saw $15 billion per quarter deployed in the 2021 period. We're seeing closer to 5 to 10, depending on kind of how you draw the lines on the stages. So funding of early stage companies and especially of growth stage companies is down pretty radically. I think looking forward from here, I don't have a ton of optimism that it's going to get any easier for a couple of reasons. One, I think that from a macroeconomic perspective, inflation has remained sticky. The Fed seems pretty persistent about getting inflation back down to their target before they do any real easing. So I think we're going to be in a high interest rate environment, which just means that if you've got capital, it's a lot tougher of a trade-off to go do something highly risky like venture, and especially early stage venture, relative to being able to go collect a healthy 5-6% by basically putting it in the bank. Speaking of banks, credit's also super tight given, we heard about the SVB and other kind of banking issues happening earlier today. So I think just overall, credit's pretty tight. Global macro environment's not looking any rosier anytime soon. And maybe the biggest point of all is that VCs themselves are not raising. So as a function of what happened last year, a lot of the LPs have really pulled back. They were really over-indexed to private equities in general. That includes both kind of later stage traditional private equity as well as venture capital. If you look at the stats, VC as an industry raised about $170 billion in 2020. Almost $160 billion in 2020. On an annualized basis, as of this year, VC raised $11 billion in Q1. So the numbers look nothing like what they used to. And so I think what you're actually going to see happening is that while a lot of VCs do have dry powder from sort of recent funds raised in recent years, that capital is getting deployed in a much more cautious way. And new funds are not being raised at anywhere near as rapid as a pace. So that, I think, makes for a pretty tough market in the going forward picture. That's my view.
I feel differently. I am super optimistic about where we're going. Right now, we're in a tough spot, but I'm so optimistic about the future. We are currently fundraising, and it is it's hard, but it's always hard. I was just talking to you. It's always hard to fundraise. I mean, that's just part of the game. I think the markets, you know, the SVB thing was just like, I'm so sensitive to all the people who just lost their jobs. Lots of my friends, I worked with SVB, over 50% of my portfolio worked with SVB. It was like one of the scariest weekends of my life. But the opportunity that is going to come from that is really exciting. I have to say, I felt like fintech, for example, was getting a little bit stale. You know, what could be new? What were the new opportunities? And now we're going to see new banks. We're going to see new insurance products for banks. There's so much opportunity there. We also invest in future of family as a category. And COVID, for sure, everyone in this room hopefully can understand, put moms on the map. I'm a mom. I don't know who else is a mom in here. Some people. I know there's some moms in here. And, you know, this is a really big opportunity as well. We were actually going after childcare as a market, and we're investing in a lot of childcare services and products, and they've all doubled in value in the last year and a half. And so we said, okay, well, how about for our next fund, we go out and we focus on childcare. I got a lot of pushback, and a lot of people were saying things like, is that really a big enough market? And I was like, you know, it's $520 billion, but like, challenge accepted. And so we did this huge study called our Future of Families study, and realized that it's actually future of families as a category, which is childcare, ed tech, anything in and around the home, which we need so much innovation around. That is a $7.5 trillion opportunity. So I look at, like, we have so many problems to solve that I actually think women will be solving, and we need more capital going to women. I think this is just the most important time not to live in fear, like to put your dollars to work. I'm not super trusting of the government right now, which is, I think, why I'm like looking at other opportunities. But I think investing in venture is a really great time. You know, as you were mentioning, some of the greatest companies in the world came out of, or the biggest companies in the world came out of the last recession. And we have that opportunity now, and we have that opportunity to like flip everything, specifically for women. And also, let's be honest, because we're in a great room of powerful women, like, we're gonna fix this. We're gonna solve this problem. Our government's in debt. Like, we don't have childcare yet. We've basically been giving 98% of private wealth managers, who are men, the ability to control the capital in the world, and the men have been gambling it away on spaceships and many other things that are completely unnecessary at this moment. However, childcare has been broken for many, many years, and it's an enormous opportunity. So I'm hopeful, and those are two industries that I'll mention, but I mean, there's so much opportunity in healthcare and many others. So I think that's where I stand, is I'm very optimistic about the future and the women at this conference. I'm so grateful to be at this conference, first of all. I think the women at this conference can make change and spread the good word and really push things forward. So I hope you all take something from this conference and like push it forward in your work, specifically in the avenue of women.
So I say I do spaceships too.
Yeah, I mean, we have an autonomous plane company, but I feel like you have to like think about the actual problems we're fixing.
I'll blend the two answers that I just heard, and that I do think that things will get worse in terms of fundraising before they get better, and I think it will be difficult for some time. That being said, I actually think a more challenging fundraising environment can be a strength, and in a weird way, I actually think in some ways it's healthy, because it does separate, I think, the stronger companies from a lot of companies that might have not had the fundamentals there originally, but we're able to get a lot of funding and absorb a lot of the time and energy of the venture community, perhaps not so deservingly. right? So, I mean, if we're just giving an example, in 2021, you could be 3 guys in a basement with a concept art drawing and probably get funded for $100 million. That's money that's going away possibly from another business that's solving a real problem and has real business fundamentals and is looking at things like, what does EBITDA look like? And how do I actually create money for my investors through this? And so in some ways, I view this as a healthy rebalancing. I think for the reasons that Aidan brought up, we are in a high interest rate environment. I think that we will see it get worse as venture funds who currently do have dry powder actually are unable to raise. So I think there's people who have raised money should be planning for, I would say, at least 24 months out from a cash flow perspective. And if you're talking about a growth stage company, you're also kind of getting walloped by a not great IPO market. That lack of liquidity is not helping anybody on the growth side as well. You know, multiples are down. In summary, macro is not great, and you will be fighting that. That being said, what I have seen at least is that stronger companies are still raising actually a pretty healthy valuations. And that's because even though the rate of deals getting done is much slower than it was a year ago, the high quality companies are seeing competition still. For those remaining dollars, everyone wants the same group of companies. And therefore, if you're in a bucket of being strong today, you actually can still grow, I would say, relatively similarly. When you're growing, the things people want to hear are different. No one wants to hear, I'm about to triple my head count and spend a ton of money for this next phase of growth. It's all about efficient growth. So there's certainly changes to the narrative, changes to how people think about what makes a business strong versus perhaps growth at all costs. And that sort of blitz scaling mentality, I think, is out of fashion. But, you know, it's the same thing I said to the company. I say this at every all hands, but I said at the beginning of the year of, it's an incredible opportunity as a founder to be in a down market because, you know, you can't pass 20 cars in the sun, but you can in the rain. So it's a chance for strong companies, I think, to really kind of put the gas on their ideas and actually pass companies that are struggling today or weaker companies that just absorbed a lot of funding earlier but don't really have the foundation to succeed.
Hi, I'm Monique Woodard from Cake Ventures. I'll keep it super brief because I also kind of stand in the middle of not completely optimistic about the state of play right now, but also not completely doom and gloom. I think our current environment is actually a return to maybe some level of normalcy. It kind of swung a little bit beyond normalcy and into a red zone. But for investors and founders who have only done this work in a bull market, it can be a really scary time. And I absolutely understand that. I see it in founders who, you know, are apprehensive about the fundraising environment, but who should be going out to fundraise because it's not going to get any better, at least not in the relatively immediate term. And I think that we have to come to an understanding that this really is the new normal for a while. And so what would you do if this was just the way it is, right? Would you go out and fundraise? Would you start a new business? Would you hire in a different way? It's really all about adapting to the market realities that you find yourself in. And I say that, you know, even as investors, we have to adapt ourselves to the market realities that we see ourselves in, where, you know, seed stage companies are taking pre-seed and seed stage companies are taking longer to mature. Those Series A's are getting pushed out a little bit further. And so I think that this is the new normal, and so we have to just realize what it is and deal in that reality.
Yeah, and as I was doing research for this, I saw some news, which is that Eclipse Ventures raised $1.23 billion across 2 new funds. So how do you square that with this new reality of obviously you raised funding, why do you think now was the time? Yeah,
despite the pessimism I shared earlier, I actually really do echo a lot of the points that everyone else made here about being able to, pass cars in an environment that actually kind of separates really good, strong companies from those that were the kind of rising tide, lots of funds, free money basically lifted all the boats. So Eclipse, let me give you some context. I think that will be helpful. I think there's sort of 3 key reasons why we were able to let our LPs know that we were headed to the market to raise in Q1 and actually raise successfully and close out our fund within the kind of specific quarter that we went to do it. The first is that, so I loved the conversation about, the future of family. I think your investment thesis really does matter a lot as a team. And so for us, our investment thesis is entirely around physical industry innovation. And when you think about what a lot of people learned kind of the hard way during COVID, it's that our supply chains, how we build things, where we build things, has really changed a lot in the last, let's say maybe even full generation, last couple of decades. And Eclipse is really all about how we think about bringing new technologies and sort of a modern tech stack to the way that we manufacture, to industries like construction, to things like logistics and last mile logistics, energy generation, transmission, storage. A lot of the things that really do power, maybe quite literally, our economy is where we have been focused. And it's not, been the last 12 months, it's been the last almost 10 years that the firm has been focused on this. We have 9 general partners, of which I am one. All of us have really deep operating experience in those fields. Former executives from Tesla, myself as a former executive from Samsara, an industrial IoT company, an executive from Rivian, someone from Flextronics. We really walk our walk and talk our talk in terms of understanding how the physical industries work and seeing the gap that exists in terms of where technology can really play a major role in moving those metrics that matter. So within our sectors, the founders that are starting companies, of which there are also now many more founders attracted to these sectors because, well, I think for a couple of reasons. One, everyone lived through the toilet paper Mageddon that was 2020 and all of the other things that we couldn't get or we couldn't have or that were stocked out or that were suddenly wildly expensive. And so I think just the pain that we went through collectively as a country really brought a lot more talent to bear. I also think that other maybe sort of flashier tech tech focuses like crypto or some of the fintech, there's still a lot of great work to be done there. But I have seen some really great talent migrate over and say, hey, I want to fix issues that have to do with healthcare supply chain and where we manufacture and how we manufacture some of the biologics that are actually moving the needle for my parents or my grandparents, right? And realizing that there are supply chain constraints around those things relative to some of the kind of real focus on only kind of buzzier things, prior to what we saw these last few years. So I think it's kind of right investment thesis, in terms of a general awareness, right group of partners, and also right stack of portfolio companies. We have about 100 companies in our portfolio of various stages. Many of them have either been acquired, gone public, are later stage now or succeeding, and so I think that we also have the track record to show that when you do bring technologies to these sectors, you can really make a difference. So that really resonated with our LPs, and that's how we did it.
Yeah, so, and it is important to highlight that it is possible to raise a fund in this kind of market. Jesse, you have more than 70 portfolio companies, which is wild. But so in my time covering venture, I feel like there's a lot of founders who are really, really great leaders, peacetime leaders. But it's now it's wartime. Can they evolve that skill set to become a wartime CEO? And what does that entail? How have you seen that shift over the years? And also, how can founders best do that practically speaking?
I'm trying to tie, such a good question. I'm trying to tie it to the economic downturn because you definitely see fear in some people's eyes right now. But I think also just the lifespan of our funds, some of them are hitting the year that, investors want some liquidity too. So you're seeing that too. You're seeing founders get tired. I think I'm in the business of seed stage investing. So we bet on, 3 to 5 people on a team with an idea and a deck and, hope for the best. And then double down. I kind of joke with our founders, like, you have 2 years to prove it to me, and otherwise you're not getting any more money from us. And then, we save 50% of our fund to double down on the best. So we watch that regularly as a progression. And I think the good that's part of venture capital. You need to be really, really good at staying close to your businesses and seeing who can get through that. And it's very, very clear. I'd say even within like 6 to 9 months. And for me, it's even simple things like just founder behavior. Are they open to new ideas, but do they still have the vision? They'll sort of receive lots of feedback, but then say, okay, well, this is the best direction for the company. Do they put the company sort of before themselves in some ways, like in the boardroom? And then even with things like, some founders, it's pulling teeth to get information out. And sometimes I'm literally like on the board and I'm like, you need to give me this information. And so I sort of, like, you see those patterns, like, are they updating people regularly? Are they, keeping in touch? Are they transparent with you and making sure that, like, keeping you posted on the good and the bad and making sure you're able to help. And then there's the founders who call you and, true story, have $6,000 left in the bank and, basically that's a month of runway or something. And you have to just kind of figure out what to do. We sold it. We made some money back. It wasn't the greatest. But I think you see that, and like, I think VCs have to kind of like watch that progression all of the time. In terms of war founders, I'd say Lauren Schulte from Flex, which is an alternate tampon device, would be an example of someone who I saw, put the company before herself during the SVB crisis in a really amazing way. You guys can all read it. She wrote like a thing on CNBC. It was like an op-ed about how everyone was saying SVB only supported like big tech. And she said, look, I'm a small business actually, and I didn't know if I was going to be able to make payroll. So I took my savings and made sure that I could pay my team with my savings. And she's like, I have 2 kids. And she wrote this whole tell-all about it. And like, that was real, like, I mean, that's really like a war hero to me. Like, she's building this business, taking care of her team. During that time, for those of you who weren't involved, like going in that Friday, all my portfolio was terrified they weren't going to be able to pay their team. And because the bank was shut down, we didn't know if they'd open it back up. And then the government is like, we're in charge now. And I mean, I don't know, I just wouldn't trust the government to like go through all the bank statements and make sure that everyone has access to their bank accounts. So they were all worried about that, and there was a legal issue if they didn't pay their team. So they couldn't delay it at all. There was a major legal issue. So I did have teams who had to lay off people literally that Friday. And so watching Lauren kind of do that was an amazing thing. And we had quite a few other founders who thought that way too.
Yeah, that's really incredible. Monique, you originally planned to raise $20 million, but you eventually chose to close the fund earlier and just move forward with, was it 17 million? 17 million. How did you make that decision, and what factors did you consider?
So I raised a $17 million Fund 1 as a solo GP who was a Black woman in 2022. And I was going to run this fund whether I raised $30 million or whether I raised $5 million. And so there wasn't really a decision to be made. I did my first close in March of 21 at $5 million, and then I just kept fundraising, kept closing, and started, went to work as soon as I, had $5 million in the bank, or, in the bank-ish. I think I am on a path to having $1 billion in AUM, and it didn't matter to me whether I started at 17 or 20. Like, I think if you're the type of entrepreneur because that is what you are when you start your own fund. If you're the type of entrepreneur who believes in what they're doing, a $3 million gap isn't going to stop you, right? I think if a $3 million gap stopped me, then I probably don't deserve to be running a venture fund. And I think that, you know, I wish I could say that those are hard decisions, but those aren't really hard decisions. Those are decisions that entrepreneurs are making every single day. And, you know, your job is to make the hard decisions and figure out what your path forward is, even in the most difficult times, which we are certainly in right now.
And I was going to say, I wish I wrote it down, but I read this amazing quote by you where you said, like, fundraising process was like walking on glass through sand. What was it?
I know what you're talking about.
You know, so how was that fundraising process?
I said that fundraising for everyone, whether you're male, female, whatever race or gender, is always hard. It is definitely the hardest thing you will do is to start a venture capital fund. Fundraising as a woman is like crawling through glass. Fundraising as a woman of color or a Black woman is like crawling through glass, and then they throw fire ants all over you. But, you know, I think if you want it hard enough, you get it done. And if you have a big enough vision, you just move through it. And hopefully, you know, as I continue to progress in my fund, that will make it easier for the people who are coming behind me.
Kirin, you have some really impressive investors, one of which is Mark Cuban. And I was reading some stuff that he said about you, and he's publicly noted that he chose to invest in you because you're different from a standard tech bro. It's like, obviously. Do you have advice for like fellow founders? Like, tell us a little bit about the conversations you were having with somebody like a Mark Cuban and what you think he saw in you that made him be like, yes.
You know, I think we've touched on this actually in almost all the stories of really fundraising, regardless of whether it's a good environment or a challenging environment, is about to wildly oversimplify three things, right? It's the why this, like why does your company or your idea make sense in today's market? Why now? What about market timing makes this the right moment for them to give you money? And then why me, which is why are you the right person to take it to the end? And I think Adrian spoke to this a little bit as well, even on the venture side of, I think having authenticity to what you are building is really critical. And I think that's probably what's behind that quote from Mark Cuban calling me not a tech bro. I'm flattered. But I'm certainly, while not a tech bro, there's no doubt I'm a tech nerd. That's my background, that's my passion, that's what I live and breathe. And that's why I started the company, and I think that's what has made it a good fit for me long term. Of this has been 6 years. I hope it's the next, I don't have to be alive in 60 years, but you know, I hope it's for the long haul. That's how I think about this. And I think when you are fundraising, being able to clearly express in your storytelling what that, whether it's the moment of inspiration, whether it's your background, and showing that that's a core part to why this company is going to succeed, I think even in a growth round is important to do, because it creates confidence, right? It creates confidence in the vision. It creates confidence that you've seen enough, done enough, that you'll be able to guide the company through, to be frank, unexpected times, right? Even this year, I didn't raise in the best of times, but it's gotten worse since then. You know, SVB was, yeah, I've already blacked out that weekend, but it's a real test of how you're able to run a company as a CEO, and something that's truly unexpected. And I think that's where it's almost, it's founder company fit that I think becomes really important in those moments.
And as a founder, because you founded the company 6 years, I was going to say 6 months ago, 6 years ago, you've seen kind of the roller coaster, right, of the market volatility. So as the founder on the panel, how have you, like, practically transitioned from a peacetime CEO to a wartime CEO?
So I run an augmented reality company, so I haven't really been, this is not my first time going through down cycles and up cycles. We've had hype cycles, we've been in winter before. This is certainly worse, I think, in the macroeconomic environment than anything I've dealt with prior. But honestly, as a founder, you're dealing with crises almost every day. almost my entire job is at some point dealing with a crisis or something being on fire. SVB was worse than what we were used to, but in many ways it is the same headspace, and I think you as a person have to be able to kind of dig deep and view it as an opportunity. When we realized how bad this was going to be, I think sometime early on Thursday, I want to say, is when it really, or maybe it was Wednesday night, there was some moment where I realized, oh, this is going to be a huge test. And what I told myself is, I have a bunch of new investors, and actually this is an opportunity for them to see my leadership, for me to show my company and show my investor base that I am capable of handling the hardest things that are thrown at me. And I think when you view it as this is a challenge that I'm going to overcome, and you ignore the things that are truly out of your control, if SVB goes down and your money's in it, then there's nothing you could do at that point. But if you have thought about everything, you have communicated clearly, you can show you're not panicking and acting reactively, but actually thinking about what are the strategic implications and what are the ways in which you can kind of hedge against that, I think it's an opportunity. And I think that you have to view every challenge as an opportunity as a founder.
Yeah.
I would just echo, actually, because I'm listening to the answers about wartime CEO, and I actually think that what is a hallmark of a great CEO or investor is consistency. Mm-hmm. And so it's a level of focus, hustle, and hard work that actually make a distinction from how CEOs are behaving today versus how they behaved last year versus how they behaved 3 years ago. If there's a really big difference, that's kind of a warning sign. And I'd say the same thing is true for us as investors as well. You know, if we're riding the high times and not paying attention to our companies because it's easy to raise and everything is la-di-da, the likelihood is that you're not meeting the best people. You're probably not getting the right price. You're probably not really developing the relationships with the founders that are going to lead to a really long-term relationship and successful outcome. So I'd say, we don't behave any differently today than we did $1 billion ago, than we did, 2 years ago, than we did when the firm started in 2015. It's a real next day mentality. We closed a $1 billion fund, and we all got together for a retreat, and we did a retro on the ways that we thought we could do better. And it wasn't about fundraising; it was about what was going on in our portfolio. Where we needed to pay attention, how we were going to make sure we were seeing the best deals and the best founders, and kind of what our key priorities were. I think that is. I think that's how great teams and great founders operate.
Absolutely. How many of you guys here are founders? Oh wow. Okay. And investors? Okay. So I would love some input after I ask this question, but I remember a few years ago, it's crazy how quickly this stuff changes, because I remember interviewing Reid Hoffman about his blitzscaling book, and I remember what he told me was blitzscaling is basically you jumping out of a plane without a parachute, and you just got to figure it out on the way down. And I was just like, oh my God. And so I was like, but that could be catastrophic. And he was like, exactly. So now though, there's much more of a emphasis, I think, that VCs place on profitability, or at least some sort of eye to profitability. So in the founders in the room, how important is profitability to you, versus are you still thinking about fast growth? Yeah, Nasreen.
Hi, everyone. I'm Nasreen. I'm co-founder and CEO of Vernique. We are a deep tech AI startup working on making sure that human language is the new machine language, which is the area that I've really dedicated my whole life to. To answer your question, I think that it has a lot to do with the whole state of the economy, right? In our world, my co-founder and I, we founded the company 2 years ago. We came out of stealth just a few weeks ago. But 2 years ago, we knew that we were planning the 10-year game for ourselves. We wanted to make sure that we build a sustainable company for years to come that will ultimately IPO. And with that, we thought, okay, we should actually show the track record of how you can build a sustainable business and then scale it, right? Whereas, of course, likes of Reid would like to think that you should, look at his own track record. He has now co-founded this other AI startup with $250 million initial investment without anything, right, just on a piece of napkin. But he believes in doing that. And to be honest with you, this is something I would love the reaction of the panel to as well. As a founder, you question, right, whether or not you should make these decisions based on your judgment call or what the broader ecosystem kind of entails and dictates to you, right? So in our world, we actually decided to raise a very small amount of money initially, and now we have the track record, we've proven, blah, blah, and now we are raising a very large round. Whereas, to be honest with you, if I knew what I know now, maybe I would have done what a lot of these other male CEOs did 2 years ago, and I would have raised $100 million then on the piece of napkin, right? So I would think that it's hard. It's a hard decision, and these kinds of forums definitely helps. And I wish I had the answer, and I would love to see if anyone has an answer to it.
I mean, we take profitability so much. We always took it very seriously, and I don't know if that was like a female founder thing or if it was we just were very realistic about like where a company was at, and if they had an inflated valuation like the Ubers of the world, we'd sort of be like, okay, well, are you going to be able to hit that in revenue? And I think we've always thought about that, and it's interesting because right now, you know, at a venture capital fund, you're like ranked basically on this thing called IRR. And it's like time-based and then how many markups you've had, essentially. And so it's kind of like a gamed system. And I occasionally have LPs be like, well, if you told me this company in your portfolio is doing so well, why is the IRR for that company not as high as it should be? And I'm like, oh, because they're profitable. And it's interesting that that isn't reflected in a venture capital fund's sort of ranking, because those are better businesses. They'll sell for more, you know, we'll have better returns. And so I think I value profitability significantly. I think, you know, many of our companies are profitable, and we're very focused on that right now, but always.
Go ahead.
I think it's threading the needle, to be honest. I think there was a moment in time a few months ago where, and I'm talking more about growth stage funds, I'll say, where profitability was back in fashion. And I want to say that lasted a month and a half. And I think it comes down to the reality of what you were just pointing to, which is you have to think about what is the incentive model and what are the financials for the person on the other side of like, how is your investor thinking about this? I think actually founders don't spend enough time thinking about where incentives align and where they might diverge. And I think the reality is for a VC to give you money, they need or expect a huge return. You building a stable, profitable business is not going to get them there, right? It's not. They're not interested. You have to have growth. And I think if you are planning to hit profitability and not ever raise again, then that's an important decision for you to know. If you think you're going to have a slow growth, profitable business and raise venture capital dollars, and I'm talking very specifically about venture capital here, I think you're probably mistaken. And so I think really understanding the type of business you're growing and matching that to however you're planning to fund or fuel that in the next round is critical. It doesn't have to be VC, but if you are, I would still say that growth, albeit efficient growth is what I'm hearing now, which is grow but don't spend so much, is probably still king in venture capital dollars.
Yeah, there's always a stage where you won't be profitable. Like that's why you're raising funding, right?
Yeah, I would just add to it, very on point, Kirin, I agree with what you're saying. It's about growing a sustainable business as rapidly as you can. So if it costs you $5 to acquire $1 of revenue, you know, some companies do that actually for a little bit, but there has to be a path to sustainability there where over time, as you grow into that, those numbers can even out, right? You have to have a company that's got the kind of gross margins that will lead to a pretty exciting multiple as you think about kind of exits down the line, right? So a lot of venture investors, to your point, are looking for like higher gross margin companies because those are the ones that are, generally pretty tech enabled, right? So 60, 70, 80% gross margin will allow you to do a lot with that business over time, where the cost of acquisition for your customers isn't kind of wildly out of whack with like longer term market standards as well. So I think that there's still a lot of room for, early R&D, getting the product built. Like, yes, you're going to be pretty unprofitable for many years as you grow your business. But I don't think it's like throwing yourself out of an airplane unless you know who's on your back, how the trajectory downwards, how the parachute kind of goes out. And actually, so I think there really is, it's not a crazy analogy in that people do launch themselves out of planes successfully every day and know that they're not going to die. But it's because, you actually have a plan and a strategy around it that is scientific in some respect, in the same way that you can look scientifically at your business and know how you can grow successfully.
Yeah, no, I think that's exactly right. And thank you for the nuance around like growth and profitability. Like if you're just going to be a profitable company, you probably don't need venture funding. But to close this up, I would love to go around and kind of ask you guys, what industries or sectors do you think will be the most resilient in an economic downturn? Like where do you see the most opportunity, for example, if I'm thinking about starting a company?
I feel like now you might hear like all of our industry biases, right? But yeah, I mean, I'm pretty excited about the physical industries. It's actually really fascinating because manufacturing is always like as a sector, is like a leading indicator of a downturn, basically. Like it gets hit first and fast and there's a bullwhip effect. Not now. Right, so I don't think manufacturing overall in the U.S. is like super thriving right now, but there are these significant pockets of growth, and so I'm very excited about where we can bring things like 3D metal additive or sort of metal fabrication that's really tech enabled and other types of componentry back to the U.S. or near shore to cut out some of the carbon footprint and deal with some of the supply chain challenges. Same thing is true for full manufacturing automation. Construction, we have a housing crisis, right? There's just simply not enough housing stock to help us curb inflation, to deal with like a growing population. We need better ways to bring more housing to people, and there's a huge role, I think, as well for more technology to kind of help move the needle on some of those issues too. Energy, we are lucky in this country to be somewhat more energy independent than maybe other countries, and I think we've seen some of our friends in Europe really suffer in the last 12 to 18 months. But nonetheless, we need new forms of energy storage in order to be able to bring the renewables online that we have big plans for, right? Like the government just put out I think like a $300 billion Inflation Reduction Act package to try and bring more renewable infrastructure to the U.S., but we don't have a way of actually getting solar and wind energy into our grid effectively and efficiently because we can't store it anyway. So we have a surplus when those types of energy sources are high, and we have a significant dearth when they're not. So we need storage, and we need sort of smarter ways to get stuff back into the grid. So these types of infrastructure meets technology companies are what we're all about. Should anybody be listening at home today and get excited to come, sort of build a company in that space, let me know. I'm all about it. So I'm really excited about those investment themes.
I mean, I obviously already hammered home my future family focus, but what I would say is just, childcare, I think people think is the physical locations, and that's actually the least of which we're investing in currently. So I like to kind of stretch people's minds around that. It's a really exciting opportunity. We have Hop, Skip, Drive, which is basically solving the problem of just getting kids to and from school. They have 3 revenue streams. They have an Uber-type service for families and childcare. They provide transportation for 30 states' foster care systems across the country. And then they also collect data on school buses because kids are not necessarily getting to school in America, which is mind-blowing to some because they don't have access to a school bus. And so they now sell that data. We also have WeCare that has, it's like the tech overlay to 55,000 in-home vetted childcare locations. I'm really trying to tackle that affordable childcare category. and they're the most affordable option I have found. And they make money with corporate benefits programs. They work with the government, and then they also, handle the payments and work with the educators in these 55,000 childcare locations. Affordable childcare is a problem. It's unaffordable completely, and it's especially for that 0 to 6-year-old. Ideally, at 5 or 6, you can go to a public elementary school of some sort. And then we also have a company called Binti that is putting adoption online, and they now work in about 27 states across the country with their social services agencies. And so they have 5 SaaS tech products that are from, matching children with families, because social service agents in the past would handle hundreds of cases on their own and not be able to match these families. Like, they were literally doing it by hand. The founder was like, I was meeting with these social service agents in their car, and it would have a Post-it note on their dashboard saying, family of 5 looking for toddler. And this is a pretty important industry. Time is of the essence, I'd say, in terms of getting these kids in families. And so they now have 5 tech products servicing everything in and around the social services agencies. So I'm super excited about childcare within this larger future of family category.
I'll break this question down, I think, in 3 different points. So one, if you're just saying, what do I think is more bulletproof going into the future, I'd say what we've seen is obviously AI is a huge, anything AI enabled, I think that will open up a huge amount of opportunity today. And certainly that's played into our company, I think, in the timing. But if the question, to point number 2, if the question is what should you and go build, I think that that's actually completely unrelated to what's interesting right now. And to go back to founder product or company fit, you should build what it is that you know, what you understand, what you're passionate about, what you have a unique insight on. Ignore the noise, right? Ignore what's hot right now, what the trend is, what you think will sustain, because the world changes very quickly. And at the end of the day, if you know and you live and breathe what it is that you're going to build, that's going to be far more important, I would argue, than some of these macro factors. And 3, to that, kind of building on that, I like to kind of give the quick test of, if you're thinking about starting a company, I think you should be able to answer in 10 years, the world will look like X. It's the vision part of what is your vision of the future? And I think how your company plays into that gives you a tremendous amount of clarity in working through the down cycles and the downturns and the hype cycles on the flip end of it, and actually stay really focused on your North Star. So that's what I was saying.
I continue to be really excited about the ways that people are changing alongside technology. It's what I bet my firm on is demographic changes, right? And so aging and longevity, people are still going, this country and countries around the world are going to continue to get older and older, and we will have to figure out how to help and manage our aging population. The power of the female dollar is incredibly exciting right now, driving companies to billion-dollar-plus outcomes. And then, we have a rising new majority where people of color, Latino, Asian, and Black become the majority in the United States and are already the global majority. And so those are things that will be happening no matter what happens with technology. So artificial intelligence certainly plays a part. New technologies will certainly play a part. But it's really thinking about the ways that people interact with technology and the ways that the internet user base is changing. I think one area that I've been spending a lot of time in that is incredibly resilient has been healthcare. My last 2 deals have been healthcare deals. I did a seed investment called LE Health, which is a saliva test for continuous monitoring of your hormones as a woman over time. I also invested in a company called Guaranteed, which is tech-enabled end-of-life and hospice care. I think these are companies that are that really represent things that people need. They're not JPEGs. They're real concerns and things that people actually will be faced with if you live long enough. And I think those types of companies are going to be incredibly resilient. And then marrying that with technological innovation is how you kind of supercharge those industries.
Amazing. That was an amazing conversation. Thank you, guys.